This is shocking. I'm your host, Steve Van Metre, and thanks for joining me today. In our lead story today, Beijing's surprise announcement has implications for global stability. And when we talk about global stability, we mean the glue that holds us all together, and that is the global economy. And China's shocking move now is threatening to send their economy and the rest of the world into a deep recession. Now let's head over to Bloomberg, where we picked today's story up with a headline: is China drains cash via key funding tool for the first time since 2022. And this doesn't make any sense of why they would be pulling cash from their economy, because they're already seeing deflation in their consumer prices. We know their property developers, one after another, are headed into the solvency. That means their banking system, on large, is insolvent. This makes absolutely no sense, because if we look at the two biggest economies that could send the world into recession, it's China and Germany. We already know Germany's talking about stimulus. The problem now is China, for no reason whatsoever, is withdrawing it until you find out what the real move is about. The People's Bank of China withdrew 94 billion yuan of cash from the banking system on a net basis to avoid excessive liquidity, while it kept the rate on its one-year policy loan steady at 2.5% on Friday. The rate decision will likely disappoint investors and economists who anticipate more stimulus is needed for the government to achieve its ambitious economic growth target of around 5% this year. It's worse than that. It's not about hitting its growth target. It's about not spiraling into a recession, because we know that when property sectors go, economies go with it. We've seen evidence after evidence of China's economy slowing down, and that's actually spreading all across the world now, as investors have been expecting rate cuts in China this year, which would make perfect sense here. We'll make the case of why they do indeed need rate cuts and why the U.S. will be soon to follow, as the world's second largest economy struggles with deflationary pressures. And that's the exact point here, is when you're facing deflation, that is a contraction in demand, how do you spur it? Well, China's hoping the rest of the world actually does that. It's not happening, so they need to look domestically. And what are they finding out? Their own citizens aren't spending in big ways, because after a years-long property crisis and sluggish demand, the U.S.-China rate differential has also hammered its currency. And now we get to the key point here, as exacerbated capital outflows amid a weaker than expected economic recovery are causing problems here. And the real issue now comes down to the yuan. It's really strange to see China willing to sacrifice its economy to protect its currency. It just goes to show how little a lot of these central bankers and political elites understand how fiat currencies work, because one of the challenges is when you don't have economic growth, when people do not want your goods and services in a debt-based global economy, well, they don't need your currency either. And as we look at the U.S. here, because we're going to see how this is opposite of what happens in China, when we look at the consumer price index against the nominal broad U.S. dollar index, what we see is when the U.S. sees disinflation or outright deflation, what happens to the dollar? Well, it goes up. So you think about China's case here, it's the exact opposite. Again, you see here CPI goes down, dollar goes up, and all it's showing is there is demand for the dollar, which is one of the cases of why the dollar still could rally here. But remember, if the dollar is rallying, it means the yuan is falling. That's a dangerous move, because that's the opposite of what China wants. In inflationary periods, that means global demand is increasing, demand for the yuan is increasing. But as we look around the world, now we'll turn to Maersk, there's heavy evidence the global economy is in far worse shape than most people believe. And any attempt by Beijing to prop up its currency, then let its economy go, just won't work. As container rates are now dropping to unsustainable levels. This is from Maersk CEO. And here we can see something that shouldn't be dropping to unsustainable levels is your trading account. Many people ask, do your systems really work? And the answer is they do. You can make a ton of money. That's why we have them, and you can do it at a super low price. The best part about it all, I give you a free month to make money, to show you why. One trade You can pay for your whole subscription to reports. Here's the 2 best trades between February 28th and March 8th. This went out to all of our subscribers. We even put videos out. Look at this. March 1st, GDXJ up 14.7%. That's as of close of business Friday. Palladium up 6.39. How about on our Momentum Timer Pro? These are all our subscribers that you're looking at on 326 triggered. GDXJ and GDX up respectively 14.88 and 13.39%. Again, one trade changes everything for you. What do you get? Well, CTA Timer Pro, that looks at the machine positioning. This is our deepest signal. If you're looking for the signal that is at its deepest level and making a reversal, that's the report you want, because we take that machine positioning when we show you these extreme shorts, and we do it on a historical basis. So we show you when there's a dislocation in the market, put out a little video to help you trade it as well, so you can make these big returns like a lot of our other subscribers. How about Momentum Timer Pro? They look at those tactical signals like the RSI and the MACD that everyone gets in so late for, and they get out early and they're jumping all around. We smooth it out because we add one proprietary signal that nobody else uses, makes all the difference, gives you nice clean signals. You get the report, you get the videos, you get everything, and a free month to make money, which is really impressive. Check out links in the description. They have the coupon code when you get to checkout. Make sure you use it and join the rest of the group and start making money. Unlike China, maybe they need to get on those reports, because Maris last month warned that China shipping over, or container shipping over capacity would hit profits this year, in contrast to the record earnings achieved in the wake of the pandemic. And that's a sign that what happened during the pandemic is there was so much money flooding the economy. A lot of people made money. And what happened in the shipping industry? They bought into the narrative that everyone's believing, and that is demand was going to reach new highs, that everyone during the last economic expansion was just holding back their spending, and now they're unleashing. Well, it turned out that without all that stimulus money, the global economy is barely going to stand on one leg. As freight rates have fallen significantly since the good years of 2021 and 2, we have fallen actually to unsustainable levels. That's never a good sign, because that always means layoffs are coming. As container rates jumped in December and early January, as vessel attacks in the Red Sea forced companies to redirect ships away from the Suez Canal to a much longer journey around Africa, but have since faded as available capacity still exceeds, there's a key word, demand. And so when we look around the global economy and we talk about China, what do they need? Global demand. And what the shipping industry is telling us is not just the fact that we have more ships now, we have bigger ships, which would be great if there was demand. The issue is there's a severe lack of demand. And an influx of new container ships last year added 9% to the industry's global capacity, which sounds like a lot, but it shouldn't be a big deal if the global economy is expanding, which is expected to increase, get this, by another 11% this year and a further 7% in 2025, suggesting that if we do indeed hit a global recession, that container rates are outright going to collapse. We're going to see perhaps even shipping companies go into insolvency. Already we can predict that now. And we know that we're not seeing a lot of global demand just based on the import price indexes coming from China into the U.S. against the U.S. Consumer Price Index, that one in blue. And we know that when import prices are negative, that's anytime the red line is below the horizontal black line, well, that means demand from the U.S. for Chinese-made goods is weakening and contracting. That means, of course, you get deflation now pushing across from imports into the U.S. economy. And while many people believe that inflation is going to rear its ugly head, and we'll hear from Fed Chair Powell next week that that's his expectations of what's going to happen, well, as long as import prices stay negative, that coming out of China, the odds of a big surge in inflation is actually low. What it does do is it keeps inflation here in the U.S. in check, and along with global demand, because one of the issues China's facing that makes perfect sense, that if they saw this and understood this, they would cut rates. This is something we've been saying for a while. It's something in the U.S. needs to happen, because I'm going to show you the U.S. data here in a minute, but China loans grow at the slowest pace on record amid weak demand. Now, in a debt-based economy, what is the one thing you need? An expansion of new loans. That is so critical. And how do you get people to borrow money? Well, If the global economy is expanding and people feel that there's opportunity to borrow now and make money, they will do it. The challenge is, if they're not borrowing, what is the one move you need to make? Well, that's cutting rates. You got it. The stock of yuan loans grew at 9.7% in February from a year ago, the lowest in data going back to 2003. It was the first time the rate dropped below 10%, showing a slowing demand in loans for China. The stock of aggregate financing, a broad measure of credit, expanded at just 9%, also near a record low. Again, this is dangerous news for debt-based economies. The M1 money supply measure, which includes cash in circulation and corporate demand deposit, weakened to 1.2%. Here again, the lowest level since January 2022, and that indicator is closely watched, given a slowdown signals that companies are not planning to use money in the near term or to invest and expand production. And why wouldn't they? Because global demand is actually crumbling, and that is dangerous. Now, let me show you why the Fed should be cutting right now, why China should be cutting, because what you need is the creation of new credit through the banking industry. Beijing is missing this. A lot of people are, including political elites here in the U.S. That meaning also the Federal Reserve. Here we see commercial industrial lending. This is U.S. data on a weekly basis, shown on a year-over-year rate of change against the federal funds rate. That's shown in red. And what do you note? That decelerations or outright contractions in commercial industrial lending, because remember, banks create money when they lend. Commercial banks do that. So as you see decelerations in lending, what happens to the economy? It slows down too. And when you see a contraction, well, that means money on net's being destroyed. And when you need to fix that problem, you need people to borrow money. What usually works? Cutting rates. And sure enough, that's the evidence we see in what the Fed's move when the commercial banks start cutting back on their lending books. Well, the Fed usually starts lowering rates, except this time we're in contraction at about minus 1.6% year over year. And you know what? I put a big question mark is why is the Fed not reacting to this? It's because they don't understand the own system that they regulate. The key problem is demand in the real economy. Well, we're going to see that headline here in the U.S. before long. And that can't be solved just by monetary policy. Well, it would help if you cut rates. Markets may have to lower expectations for credit growth further. And that means China's economy is headed into a recession. And so this makes perfect sense where we started the show, is why are they pulling liquidity out of the system? That doesn't make any sense. They're already seeing deflation in their consumer prices. And now their experts are saying, well, we may just have to accept that things are going to get worse. Well, if they get worse, that means your property developers aren't just going to be insolvent. They're going to be bankrupt. And when they go, your banking system's wiped out. And you want to see your economy stand on its 2 feet then? Good luck. As borrowing demand in the world's second largest economy has been sluggish and getting worse, and weakness at the start of 2024 threatens to make Beijing's economic growth target of around 5% all the more difficult, I'll say, how about this? Impossible. Not going to happen. You generally do not see growth targets hit, whether it's in the U.S. or anywhere else, when there's a contraction in lending. It's very rare unless you've got a ton of money just sitting in the economy, as China has also experienced weak or negative price growth across its economy in recent months, which should weigh on loan growth because people tend not to borrow money when the economy is contracting. And why don't they? Because they know that means they're going to lose their job soon, and they start to worry. They start holding on to cash and paying down debt. And sure enough, what do we see here in the U.S.? Real GDP, that's shown in red against commercial industrial lending. That's still in blue. Weekly data on a year-over-year rate of change. What do we know? Decelerations in credit tend to lead to a deceleration in the economy. You'll note that there's a reason why you see GDP growth coming out of these deep levels. Well, that's because the Fed has usually at that point cut rates. You'll notice the gray shaded bars are recessions. At that point, rates are low, and even though lending hasn't turned around, those lower rates are spurring demand for lending, driving the economy up. We're not seeing any signs of that now, suggesting that GDP growth here in the U.S. headed toward the end of the year should outright collapse. And in a sign that bodes ill for the troubled property market, households' mid and long-term loans, a proxy for mortgages, contracted in February, meaning money's getting destroyed. And that suggests families repaid more home loans than they ramped up new borrowing. Nothing here you're seeing is good news for China's economy, but it's having implications for the rest of the world as we look at stability, economic stability. Now we turn to the U.S., where we see things here are not as good as everyone hoped. As New York Manufacturing Index contracts by more than projected, this is staggering because what did we just see in the unemployment claims? That New York said they hired a whole bunch of people. So you'd expect the manufacturing sector should be booming. Well, not so much. The Federal Reserve Bank of New York's General Business Conditions Index decreased 18.5 points in March to a whopping minus 20.9, suggesting contraction in the New York manufacturing sector. And while the manufacturers don't see a faster pace of input cost inflation, meaning they actually see input prices now start to normalize, they're still fairly confident in their ability to pass high prices on to consumers, suggesting they think you've still got a lot of money and that you want to spend it. Of course, we'll make the case why we've talked about consumers here in the U.S., particularly at the bottom end of the income spectrum, are struggling financially in a big way. That's going to affect more people, particularly as you see continued claims staying around 1.811 million, as we talked about this week. Purchasing power of Americans decreasing. That means passing higher prices not likely going to happen, as the index of new orders slid to minus 17.2 as evidence that consumers can't afford the high prices that, of course, the manufacturers think they're passing on, while the measure of shipments dropped to minus 6.9 and the index of current employment, much in disagreement to the weekly unemployment claims, retreated to minus 7.1, and it makes perfect sense as consumers reject higher prices, new orders go down, and that means manufacturing activity drops, and as we've said, employment starts to contract and the system starts to snowball on top of itself. Now we'll step back and look at U.S. industrial production. As we see output barely rises after a weather-related slump. We got to blame it on something. The Fed says it was all due to weather. How about something about the economy? As factory customers have made progress over the past year, getting stockpiles more in line with demand, as government figures on Thursday showed retail sales rose modestly in February after a big pullback at the start of the year. And what that means is, could there be a link between retail sales and industrial production? Oh, yes, and a big one. And here we can see where retail sales are going. Well, that means that industrial production does go along with it. And what happens is retailers cut back on their ordering. It hits industrial production first and then flows into retail sales. Retail sales shown in red, industrial production in blue, and you see that relationship. So the notion that the U.S. industrial base is going to see a surge higher here in demand, well, we're not seeing it from retailers at all. In fact, the decrease in January purchases produced the highest inventory to sales ratio at retailers since May of 2020. And what that means is simply consumers aren't buying as much stuff. So retailers have been saying, and wholesalers have been saying, we don't have enough inventory. Build more stuff, make more stuff, ship us more stuff. And so they did. And now they've got it. And consumers are turning around and saying, wait a minute, you know what? We cannot afford these higher prices. We don't have the income. We don't have the credit. We don't have the access to money. And that's why you're seeing the inventory to sales ratio jump. Not a good sign. A more restrained U.S. consumer, in conjunction with tepid global demand, risks limiting factory production. No, it risks sending it into a contraction, because here you can see industrial production now on a year-over-year rate of change against continued unemployment claims. You notice the beautiful relationship. As you see a slowdown in industrial production, what does that match with? An increase in continued unemployment claims. You'll notice that happens every time because demand has to go somewhere. And when you see people lose their job, have less spending power, well, that means their ability to go out and spend money into the economy to afford higher prices goes away, and slowly and surely backfeeds itself into the industrial base. But as far as inflation coming back, capacity utilization says not a chance. As factory level utilization, a measure of potential output, rose to 77%. The overall industrial utilization rate was unchanged at 78.3. And when you look at the consumer price index shown in blue against the capacity utilization, now capacity utilization is not on a year-over-year rate of change, but what you can note is that demand at the factory level starts to go down. What happens? Inflation rolls over and follows it. You see that happen every time. So then again, any notion we're going to see a surge of inflation, not going to come out of the U.S. factories. The question is, where is it going to come from? Well, it's not coming from China. Not coming from Germany, not coming from the U.S., which means anything the Fed says, of course, next week suggests that they've got it wrong too. The only question is, when's China going to step in and try to save their economy? Because based on their current moves, they're going to spread economic instability across the world. And that won't be a good sign as we head into a globally synchronized recession. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.